Yeah. Okay, partner to partnership transactions. Um, there are a couple different examples of what this means. And partner to partnership transactions generally going to be, no, that's not true. It's probably more appropriately by category, but I'm not smart enough right at the moment to tell you the categories succinctly enough. So I'm going to just describe what we're dealing with, and maybe we can come up with a categorization. What was your tax planning strategy? Could you contribute cash to the entity to avoid?
Oh, instead of sign it, just contribute and distribute.
Okay, 707. Okay, so did everybody track with what Brad was suggesting earlier? Thank you. Okay, so Jim owns AB LLC and it has land, and there was $500,000 in play, right? And Sam paid Jim 500K, right? And he got LLC units. And under 99.5, this says that Jim sold half his ground, Sam bought half his ground, and then both were contributed and you had to go through the procedures, correct? Well, Brad, the smart tax guy, said, wait a minute. There's this other situation, right? That says, well, what if Sam contributes the 500K and gets units? And Brad, the smart tax guy, said, that didn't result in a current tax problem, did it? Does everybody agree that the contribution did not result in a tax problem? That it was an issuance of units and that step of calculating gain or loss didn't matter because there was no gain or loss? And then we did our normal 704 B balance sheet, 704 C balance sheet, inherent gain. And that looks a lot like that description. And that's how Brad, the tax guy, said, why don't we just contribute cash? Is that all fair? Well, why don't we? 707 says you can't. 707 says, this is year 0. This is 2 years after 2 years. There's a rule that says if you have a contribution of cash to an entity and within 2 years of that contribution, so did Sam contribute 500,000? So 500,000 was contributed and we're year 0. Okay? With it, what 707 says, if during this 2-year period there's a disproportionate distribution of cash to non-cash contributor, okay, or Jim, right? Jim contributed ground, correct? So disproportionate distribution of cash to the non-cash contributor, which is Jim, under a fact pattern. Everybody with me? Then the IRS presumes you were in situation 1. That really, even though there's a contribution of cash, there's a U-turn, and Jim got 500, that cash coming out is the exact same thing as Sam having bought the property from Jim. This is for whatever it's worth. This is a rebuttable presumption. And what the hell does that mean? So let's say that Sam contributed the $500,000 to AB LLC. In cash, disproportionately comes out. The term rebuttable presumption means the IRS is going to assume that you're a bad actor. And the IRS is going to assume that you have a sale or exchange on that ground. But it's not a given. You have the opportunity to rebut or push back on that assumption. So the fact that you have this cash distribution within that first 2 years doesn't mean that you have a sale or exchange. So Jim is married, and Sam comes in for 500,000. Jim's wife figures out Jim's not a good guy. Jim's got to go. So she divorces Jim. Jim needs liquidity to pay the divorce settlement. So he says, AB partnership, you got 500 grand sitting there. I'd like to get a $500,000 distribution that's disproportionate so I can pay part of the marital estate to resolve my divorce. Does it sound like Jim entered into this transaction with the intention of pulling that out as a sale or exchange? No. There was no part of the divorce that was part of this plan to get this money. Might have been, but we're going to push that aside. But some other factor in the universe that says, we didn't do this because we were trying to sell or exchange an item. We did this just because of our fact pattern. So, after 2 years, presumed not a sale. But guess what? That is also a rebuttable presumption. So, what happens on 2 years and a day? Jim's not getting divorced. Jim's life's good. And we get to 2 years and a day, and this 500,000 happens to do a U-turn. Because we just didn't want to do it in the first 2 years. The IRS can say, you guys strung us along, and now you still have a disguised sale.
It's clearly a loan.
Do it?
Clearly a loan, not a distribution.
Well, the loan actually occurs in the first 2 years. That's the game I've seen played. Clearly a loan. So, what's it say? I probably should read this before. Okay, let's do this because I probably got ahead of myself. Section 707, code responded to uncertainty which approach Category 1 transactions with a partner other than a partner in his capacity, guarantee payments, all other payments in his capacity as a partner, whatever the hell all that means. Okay, 707, partner, let's see, Leslie, what's this say?
Category 1 transactions with a partner other than in his capacity as a partner. Section 707A states that if a partner engages in a transaction with a partnership other than in his capacity as a member of such partnership, the transaction shall, except as otherwise provided in this section, be considered as occurring between the partnership and one who is not a partner.
Okay, a loan transaction, sale transaction, lease transaction. Okay, these are, if I can be a lender to the partnership, I can sell property to the partnership, and I can lease stuff to the partnership. That's what that's saying. And to me, that seems relatively self-explanatory. Maybe. Okay? Leslie, who do you want to call in here?
Kelsey.
Kelsey, what's this slide say?
Section 707A transactions include the following: loan transactions If a loan from a partner closely resembles an equity investment, it may be recharacterized as a capital contribution. A loan to a partner may be recharacterized as a distribution if appropriate to reflect the substance of the transaction. Sale or purchase of property between a partner and partnership, leases and incidental use of a partner's separate assets.
Is that the last page?
How should I read?
She was one before the page.
Did I skip a page?
Maybe.
I might
I
have.
did? Nope, I did. So I'm like, okay, so what's this one say?
Sales and exchanges between partnerships and controlling partners. Section 707B limits, in two respects, the scope of the general rule of 707A that sales and exchange of property between partners and partnerships are treated in the same manner as sales or exchanges between unrelated taxpayers. Section 707B1A precludes the recognition of any loss realized on a sale or exchange of property between a partnership and a person who owns more than 50% of the capital or profits interest in the partnership. Section 707B2A provides that any gain is ordinary income if property that is not a capital asset in the hands of the transferee is sold at a gain between a partnership and a person who owns more than 50% of the capital or profits interests in the partnership. Questions
Okay.
1A and 2.
I hate all this. Okay, so you got two different provisions here that could be meaningful. Okay, and for those that are playing along and paying attention, 707B1A basically has a correlation to 267, Internal Revenue Code 267. And 267 is transactions between related parties. 707B2A has a correlation to Code Section 1239, which is sale of depreciable property between related parties. Now, why in the hell I have B1 and B2 in play when I have 267 and 1239 in play, I have no idea. I don't know what the substantial difference is because in my mind, 1239 is exactly the same as 707B2 and 267 is exactly the same as B1. So what the hell does all this mean? God bless. Can anybody read that? Kelsey, who you want to call in?
Alyssa.
Who?
Alyssa.
Okay. Okay, so which section are we specifically on, Alyssa?
707B1A.
Which correlates to which code section?
267.
267, which are losses between related parties. Okay? So what's our facts?
Okay, so A A owns land worth 100,000. A's basis in the land is 500,000. A sells the land to AB LLC for 100,000.
See, this is where it cracked me up. She left the post-its on there.
Yeah. Okay. Do you want me to read like question 1 then?
Yeah, what's it say?
So since A's loss is disallowed, does A get to take the loss in the future when AB LLC disposes of the land? No.
Okay, so let's stop there for a second. A sold the ground to AB Partnership for $100,000, correct?
Yes.
And the basis in the ground is 100,000 or 500,000, correct?
Yes.
If it were sold to an unrelated party, A would have a $400,000 loss.
Yes.
By virtue of A selling it to AB Partnership, which AB is related to,
Correct.
the loss of 400,000 is disallowed.
Yes.
So the question is, does A ever get to take advantage of that loss? Ever, 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 ever?
I would say no.
They do not. At least not as in the capacity as an individual. Now, as a partner, maybe. Okay, so what's question 2 say?
Since A did not get to take the loss and will never take the loss, is AB LLC's basis in the ground equal to A's basis? No. At the date of purchase, AB LLC's basis is equal to purchase price. of 100,000. Or 100,000.
We're 100,000. So AB bought that land for how much, Alyssa?
100,000.
So AB's basis in the ground at the date of purchase is how much?
100,000.
Okay. So what's the next question say? Because this is slightly mind bending. It's not hard, but this slightly mind bending. Or it was the first time I encountered it.
So did 400,000 of basis disappear never to be used? It depends.
It depends. Okay. Who you want to call in?
Nate.
Nate. Sir, what's happening on the next page?
So want me to start reading?
Let's see. Yeah, what's that say?
All right, so it shows us the proceeds of 100,000, base 500,000, the disallowed loss of 400,000. 4 says if the $400,000 loss is not lost, how does it get utilized? ABLLC has a floating basis. Floating basis means the basis will possibly be adjusted based on the sale of the property by ABLLC. Let's demonstrate by 4 different possible sale prices.
Okay, so let's stop there for a second. Floating basis means that the basis can float up or down based on the sale of the property by AB partnership. Have I ever seen this, Nate?
Yes.
I have. Okay, so we have the proceeds in scenario 1 is how much, Nate?
$50,000.
What is it in 2?
200.
What is it in 3?
400.
What is it in 4?
600.
Okay, so in scenario 1, we sold it for 50. What was the basis? What was the acquisition cost by AB?
The acquisition cost was 100,000.
Okay, so what loss does AB have?
In scenario 1,
Yep.
they have a loss of $50,000.
Okay, and what's my little asterisk say? Or wherever that is. What is it?
The 1
Oh,
says
boy,
basis
my
equals.
eyes just no good. What was that?
No, it says basic equals basic. Basis equals ABLLC's purchase price of 100,000.
Okay. What happened to the $400,000 disallowed loss?
It's gone.
It's gone.
Yeah.
It's gone, never to be seen again. Okay. Okay, what happens in number 2?
Number 2, they received proceeds $200,000, and we used $200,000 worth of basis for no gain or loss.
Okay, so the basis floated up from 100,000 acquisition cost to $200,000, which equals the sales proceeds. Okay, what happens in 3?
In 3, we have $400,000 worth of proceeds, and the basis floats up to $400,000 for no gain or loss.
Okay, what's note 2 say?
Note 2 says the basis floats up to equal purchase price between 100,000 and 500,000, which results in no gain. In number 2, 300,000 of basis is lost, and in number 3, 100,000 was lost.
Okay, so all that makes sense. Brett, does that make sense?
Yes.
Okay. Kelsey,
Yep.
everybody good? Okay, so what about 4?
In number 4, we have $600,000 worth of proceeds. We use $500,000 basis for a $100,000 gain.
Okay, and this is the exact same rule that's under 267. And 267 is transactions between a related party, and 267 becomes into 2 categories. One is sale or exchange of an asset between a related party that results in a loss. And the second category 267 falls into is transactions between a related party that have different accounting methods. So if I own S Corp 1 with its cash basis, and I own C Corp 2, which is accrual basis, I own 100% both of those. Those are related under 267, and the way they transact business can limit an income item or deduction item based on the related nature of those two. Okay, So 267 has two categories that is embedded in there that need to be addressed. Okay. Nate,
Yep.
who you want to call it?
We'll just go to Brad.
Brad, what do we have here? What code section are we addressing here?
707 B2A.
Which does that correlate to? The first one correlated to 267.
Yeah.
Melissa?
1239 or something.
1239. Aaron, what is Snyder's favorite code section to ignore?
1239.
1239. Okay. He's
We're
go-
supposed to tell her to stop recording first.
he's retired.
Oh,
Then she can edit it.
oh,
All right. What do we have?
A owns a house with a basis of 100,000 and a fair market value of 500. AVLC purchased the house. AVLC will rent the house and will depreciate the house. A own the house as an investment for more than 1 year.
Okay, so before we work our way through this, let's give you the punchline, because this is not intuitive. If I sell a house that's being depreciated that has accumulated depreciation of $100,000, do I have 1250 under capture gain? Anybody? Assuming a gain, yes. Okay, so the asset's depreciable in my hands. If I sell a house that is an investment, it's just capital gain. So the lens that I just used was on the sell side. That's not the lens that you use for 1239 and 707 B2. The lens that you use for 707 B2 and 1239 is what is it on the buy side. So if on the buy side, the buyer is going to hold that as a capital investment, you don't have to do any sort of analysis on 707 B2 or 1239 because the buyer is going to hold it as an investment. If the buyer is going to hold it as a depreciable asset, now you have to think, what does 1202, 1239 and 707 B2 tell me? And it says 707 and 1239 say if the sale is in between a person and a related entity, which this blows my mind, a person and a related entity, then whatever gain that is generated is going to be ordinary gain to the seller. It doesn't matter, going back to the seller, that that seller held that house as an investment. It doesn't matter that that seller held that house and depreciated and had $100,000 depreciation. That doesn't matter. It matters what the purchaser's intention is with respect to that asset. And that is mind bending. So, this is weird. This is really weird. I don't want to erase that yet. Okay, I got A, and I got S1, and I have Sun. Okay? Sun buys assets. Sun gives money. Who is the buyer and who is the seller? Sam, who's the buyer? Who's the seller? S1. Okay? And this is dad, right? So I said before, 707 and 1239 are for transactions in between a related party and an entity. Now, this is stupid. I don't even know what to say about this. So if Sun is going to depreciate the asset, 1239 is going to make And let's go ahead and give this some numbers. The tax net book value is 10,000, which had acquisition cost of 100K and a cum of 90. So my accumulated depreciation is 90,000 to get 10K of net book value. And Sun ships over 200,000, 210,000. What's my gain? Net book value of 10, 210. What's my gain?
200.
200.
200. 1239 in 707 says, well, what's if this were a sale to an unrelated party, Brad? How much would be? And let's say this is a depreciable building. How much would be undercaptured 1250?
90.
90 of the 200, and how much would be 1231?
The 110.
The 110. Okay, so we all know those rules. But 1239 and 707 say, in the hands of the son who's related to the entity, because dad owns the entity, that $200,000 gain is all ordinary. 1231's turned off. Unrecaptured's turned off. 100% of it's ordinary. Now, here's the really stupid thing. Is that what if dad just owned the building and there was no entity? Dad owned the building. And dad sold the building to the son. Is that a partner to partnership where 50% is owned and is related? Is it 1239 requires a transaction between the entity, related entity, and the person related to the entity? It's not there. 1239 is not turned on. So now you do have capital gain, or 1231 and undercaptured 1250. It's mind blowing to me. Anyway,
What if
Okay.
there are other partners in that LLC that are unrelated? At what point is it considered a related entity?
50% or more.
50%?
If they owns 50% or more.
Okay.
Or no, more than 50%. Excuse me, more than 50%. Okay, so Brad, what's this say?
If A sold the property to a third party, what would be the gain and what is the character of the gain? Proceeds 500,000. We take our basis for a $400,000 gain. Since the house was held for investment, the gain would be all capital. 2, if A sold the property house to ABLC, what would be the gain and what is the character? Should be the same gain calc. But 707 B2A says that it'll be all ordinary instead of capital.
Yeah. That to me is insanity. I think that's a really bad rule. Now, I'd say I could get on board or see the reason that if it were a 5-year asset that you had a gain on, I could see them saying, wait a minute, you're getting too much depreciation too quickly and you're getting an ordinary write-off too quickly. We're not going to allow you, Dad, to get an ordinary write-off in a very short time, and son to get a capital gain, and son to get an ordinary write-off. We have a rate arbitrage problem. That doesn't feel very good. I could see them making that argument. But something that's being depreciated over 27 and a half years or 39 years, it's lunacy. That's insane. Okay. What's this say, Brad?
3, the property / house was capital asset in A's hands, correct? Yes. When A sold the house to ABLC, the gain was ordinary. Yep. What caused the gain to be categorized as ordinary on the sale of ABLC? The sale was between A, who owned more than 50% of ABLC and AB LLC. And ABLC purchase property from a related party. A owns more than 50% of A BLC, and A BLC is going to depreciate the purchase property. A's use and facts.
Oh, so let's just focus in the bottom portion of the page. That's more my point. Okay, so this goes back to what lens are we using to diagnose the character? Does A's use matter in the analysis? Bottom left. No. But if AB depreciates it, then it's ordinary. If AB will not depreciate it, it's dictated by A's facts, which is going to be whether it's capital, ordinary, or 1231. That's going back to my original comment earlier that you have to look at the purchaser's intent with respect to that property to make an assertion or an assessment as to whether that's going to be an ordinary gain or whether it's going to be capital. It's a stupid rule.
If it's just like a Schedule E, but it's in like an LLC, does that turn it on?
Say that again.
So like in your thing on the board, you said if it's not in like the partnership or whatever.
You're saying if I have a single member LLC?
Yeah.
Because then we would operate in the world of tax fiction where the dad actually owns the house, not the LLC.
Are you asking or telling?
Telling.
That sounded pretty damn confident, Kelsey, and I love it.
Yes. Confident.
Yes, confident. Confident what exactly?
That 1239 and 707 2B2 would not.
Apply because we do live in the world of tax fiction. So even though it's legally owned in a single member LLC, then there's no A is deemed to own that property.
So if A only owned, let's say like 45% of AB LLC, would 707B2A then not apply? Does it have to be they own more than 50% to be a
Yes.
related party?
Yes. The same for 1239. Okay. Brad, who do you want to call in?
We'll call on Leslie.
Leslie, what's this slide?
Category 2 is guaranteed payments to a partner for the use of capital or for services rendered in his capacity as a partner. Section 707C states that payments made to partners for services or the use of capital are guaranteed payments if they are not subject to 707A, determined without regard to the income of the partnership, and not in substance distributions by the partnership, subject to 731.
Okay. So the one that you probably highlight and you take away from this, in my view, is the second bullet point. A guaranteed payment is a payment made without regard to the income of the partnership. That's the one that you most likely key in on. Do you have a question, Kelsey? Okay. What's this page say, Kels?
Pete and Jim are partners in PJ. Pete is entitled to a payment of $100,000 and 30% of the partnership profits and losses after taking into account his $100,000 guaranteed payment.
Okay. So PJ partnership before guaranteed payment has $60,000 worth of income. The guaranteed payment that's made to Pete is $100,000, which results in a net loss of $40,000. So that $100,000 payment is we're going to pay you no matter what. Doesn't matter if it throws us into a loss. It doesn't matter whether we make $1 trillion of income. It doesn't matter. We're going to be in a loss position. So now, Pete and Jim, these are the K1s that we have. Pete has a guaranteed payment of $100,000, and that's going to come through on the K1. But he also has 30%. 30% of the 40,000 is 12. 70% of the 40,000 is going to be 28. Pete's K1 is going to be $88,000, and Jim's going to be 28. So the thing that you take away from that particular concept is a guaranteed payment is basically a W-2 payment being made to a partner in his capacity that's not in a capacity not as a partner because he's basically an employee. He's doing something on behalf of the entity, but you can't have that being driven off of the net income of the partnership. It just has to be a payment. Does that make sense? I hope. Payments with regard to partnership income for services rendered for capital are treated as distributive share. Okay. Kelsey, who you want to call? Who did that? Kelsey? Was it you? Who you want to call in?
Nate.
Nate, what we got here?
All right. Assume that A, in his capacity as a partner in the otherwise equal AB partnership, is to receive the first $10,000 of partnership net profit as compensation for services in a year in which the partnership has $100,000 of net income. Under Section 704, Partner A has a $55,000 distributive share of the partnership income. A's basis would increase by his $55,000 distributive share of profits and then decrease by any cash distributed to him. Note, we see these types of arrangements all the time. They're commonly called waterfall income allocation.
Let's see. Do we have any sort of? Okay, so let's do this math together. So what are the rules here, Nate? We say we have $100,000 of income.
Yep.
And what's our first rule?
Our first rule is that the first $10,000 of that goes to A.
Okay. So the first 10,000 goes to A. Okay, then what?
Then we have a $55,000 distribution to A.
Let's see.
Well,
Assume that A in his capacity as partners, otherwise AB, received 10,000 for services, 100. Okay, so this is presuming that there's partner B, I think.
Mm.
Okay, so we have B. Who wrote this stuff? Was this you, Hoffman?
This one's not me. I was yesterday's.
No, it was yesterday's. Let's see who wrote this.
This is
I think it's
Harry.
Ellie and Mike Perry.
All right. I'm not going to say a word. Okay, so now what's 100 minus 10, Noodles?
90.
90. Presuming we're 50-50,
45 to each.
45 to each. So by virtue of giving the first 100, by virtue of giving the first 10 of the 100 to A, and the next going 50-50 between A and B, does that tie back to my 55,000?
Yeah.
For A? So B's would be 45,000?
Yes.
Okay, so does the fact that we're giving A the first $10,000, is that a guarantee payment?
Yeah.
Brad, how do you feel about that?
Not great,
Why not great?
because you said it can't be related to profit.
And be related to profit. Well, this is 100% related to profit. Okay. Who in here has had the wonderful experience of dealing with a waterfall? You have? How complicated?
It was pretty complicated. Like, wasn't my client. I've done it for like twice. Maybe one of them.
Oh no. Oh, what the hell? You couldn't have had to deal with that one.
Which one are you thinking of?
It's awful. And it's a Weiss.
It's not my best.
Yeah.
I did that one this year.
It's awful.
That return sucks.
It is awful.
I did it like 2-3 years ago, maybe.
Okay. And okay. So let's talk about what a waterfall means. Brett, do you know what that means?
Other than what we talked about yesterday,
What did we talk about yesterday? I swear to God, I don't even remember talking about
the
yesterday.
25 and 2 with Joe's.
Oh, that. Yeah, that is a relatively simple waterfall. But the vivacity one. Did you send me? What did you send me, Hoffman?
Sent you a couple of partnership agreements.
Is there a waterfall?
It has a waterfall in it.
Which one?
The Gladstone Partners.
From this one? It's actually a good time to talk about this.
I think page 8, I think it starts.
Yeah. On. Looking for something. I want to take a quick scan if that's okay.
Sure.
That's what we're dealing with. Who wrote this, Hoffman?
No idea.
All right.
An attorney in Chicago.
And is this from a I mean, do both of these come from the same firm?
No, it didn't.
All right.
Well, I can't say for a fact. I don't believe so.
Okay. All right. Actually, either you're going to love this or you're going to hate it. Okay, so actually, it's pretty good to me. And there's nothing in here that is training for this, but I think this is a great discussion to have. This is starting because we're starting to talk about a waterfall. But for me, Hoffman, am I an attorney?
Nope.
I'm not. So let's just get that straight. But using whatever experience I have, here's how I enter into a partnership, looking at a partnership agreement. Is the first thing I do, or one of the first things I do is, who are my players? And that's either going to be in this first paragraph or recitals. Does anybody know what a recital is? Kelsey, do you have any idea what a recital is? A recital is either a given, here's a data point, or in that it's going to be an action that's taken. One of the two. So a recital could be Kelsey is an independent partner is going to contribute her ground to the partnership. Those are recitals. So I look at this and say, who are my players? What's going on? Who's engaged in this agreement? So that's the first thing. And when I come through here, and let's see, I want to find probably on. I am looking for something that's not popping out very quickly. That's okay. Okay. Now, you see, upon the manager funding and manager additional capital loan on behalf of delinquent member, the delinquent member management additional capital loan. You see these words in the middle of this agreement that are capitalized. Okay? And none of those mean anything to me, but in a legal document, in general, if you see net cash flow, let's hope this works, delinquent member. So delinquent member share, and actually says net cash flow, that's also capitalized. So if something's capitalized in a legal document, that means somewhere in this document there's a definition of what that means. So if we come back here, we had, oh, look at that. Here's cash flow from sale of refinancing, capital account. It was delinquent member, right? Is that what we had?
And that's not true.
It was net cash flow? Well, let's go to ends and hope it's there. net cash flow from operations, meaning gross proceeds from the operations of the company less the portion non-recourse. So did it say net cash flow from operations up above? Okay, so when you see that capitalized word in the document, somewhere in the document, it generally means everybody's agreed to what that definition is. That seems useful to know because especially when you have a waterfall, you can have a definition associated with the units. There can be a preferred unit, there can be a common unit, there can be a capital profits interest unit. There's generally kind of a term that says unreturned capital means, preferred return means, preferred liquidation right means, and there's all these things that has definition. I mean, anything capitalized has definitions, and if you have a definition, it's really helpful to try to discern what it is that you're dealing with. So knowing that something capitalized in an operating agreement tells you it should be defined seems to me to be helpful. So point number one, just from a 50,000-foot view, is you're learning how to read a document. It's capitalized items, seeming weirdo capitalized items, I mean they're capitalized in the middle of a sentence, are defined terms. And you should, in general, have a definition section in an agreement. Okay? The second thing that I would say that I personally do is the portions of the agreement that I focus in on that I think are going to be helpful. Portions of agreement are one, the income and loss provisions. Two is operating cash distributions. Three, liquidating distributions. Four, tax distribution provisions. 5, 754 language. 6, 704 allocation language. Because for me, these are the items that are the rules of the game that's in the partnership agreement. And what happens and where LUTs can provide value is that attorneys think in cash. And thinking in cash creates a disconnect in between your income provision, your operating distribution provision, and your liquidating distribution. And an attorney is blind to that disconnect because they think solely in cash. And I don't think we're going to get into 100% how that disconnection works, but having awareness that that exists is that's worth knowing. So in this particular document, let's see, pass it up. That's weird. Okay.
What are you looking for, Pete?
Nothing. So as I go through, I said the capital letters, capitalized items, there's generally a definitions section somewhere in the agreement. Sometimes it's at the back of the agreement, sometimes it's at the front of the agreement. The definition section gives you indicators as to what the drafter is intending and what both parties are trying to agree to in a transaction. These help you identify what the rules of engagement are between the partners. Okay, then somewhere in here, okay, Tax matters. Oh, gee, what the hell's tax matters? Okay, that's audit stuff for IRS audit. Okay, dissolution. Let's find the section hopefully quickly.
I can help you. I got it open.
Okay, where's the boilerplate minimum gain chargeback?
Page 6.
6. Wow. Okay, that's early. Okay, that's right at the beginning of. All right, so let's see if we can figure out what the rules are just to do it. Okay. Brett, what's A say?
General allocation rule. After giving effect in order and priority to section 14B through 14G hereof and taking into account section 14I, profits and losses, or in the reasonable discretion of the manager, items of gross income, gross deduction, gain and loss for each applicable period will be allocated among the members so as to reduce to the greatest extent possible the differences between each member's respective capital account and the balance of that member's target account.
That's nauseating. We don't know what any of that means. So, in reviewing this, and I'm not sure we are going to review this because this is going to go down a rabbit hole bigger than shit, do you know what 14B is?
No.
Neither do I. Do I know what 14G is? Neither do I.
B is the minimum gain chargeback.
Are we under 14?
Yep.
Okay. Oh, fine. Oh. All right. So BG. Okay. Thank you, Hoffman. All right. What's I?
Loss limitation.
Okay, so what this is saying is after giving effect to boilerplate, and I'm going to tell you what I mean by boilerplate in just a second, and some sort of loss limitation, I'm not sure what that means, profits and losses at the discretion are going to be allocated to drive to members' target account. Is that capitalized? All right. What is members' target capital account? So we got to go back to our definitions. To members' target capital account.
We don't have it in there.
I think it was just under target.
Under target, yeah.
Where was that?
Target.
The definition target?
Yeah.
Correct.
All right. I must have missed that.
26.
26.
Right there.
Okay. Means with respect to any member for a period, hypothetical amount would receive upon liquidation, assuming all assets, all liabilities, all net assets were distributed pursuant to section 27. Where's 27, Hoffman?
Oh.
So now it says target capital accounts mean we had to pay all our assets, sell our assets, pay all our liabilities, and then go look at 27.
Page 17. No third party rights. Benefits of agreement.
Huh?
Right where your mouse is.
Oh, yeah, I get that. But what does that have to do with an income allocation? Does that make any sense to anybody? So this would be my first question to the attorney is, why does members' target account point to that account, and what the hell is that telling me? So going through going through the agreement, the definitions tell you where to go and how to look for it and ask questions. And how often am I just fumbling around like a moron trying to figure out what this is telling me? A lot. So it was page 6, Hoffman?
Yep.
Okay, so let's talk about minimum gain chargeback, non-recourse liability, qualified income offset, non-recourse deductions, member non-recourse deductions, and I has curative allocations. We'll come back to that. Okay, so with respect to what I call boilerplate, minimum gain chargeback, non-recourse debt minimum gain chargeback, qualified income offset, non-recourse deductions, member non-recourse deductions. Here's where you know you're in bounds. Is as long as income and loss is allocated pursuant to the rules of the operating agreement. Brad and I are 50-50. Losses are going to be allocated 50-50. There's no disproportionality to how we're allocating those losses. None of this matters. The minute a loss gets allocated in a manner that is not within the rules of the partnership agreement, these rules kick in. That's all you really need to know. This is New York and DC law versus what we have in Nebraska. We're generally going to follow what the operating agreement is. Because this qualified income offset is, it says, okay, and this is, it took me a long time to figure this out. What qualified income offset says is the minute your capital account goes negative, you need an income amount to offset your capital account to go back to 0. So if Brad and I are partners in a partnership and we're 50-50, and we have an AP payable to Lutz for $100,000, our capital accounts are negative, are they not, Brad? If that's our only activity? And if you just read qualified income offset on its face, we need an item of income to get us back to 0. Does that make any sense whatsoever? None. So as long as those items are, those AP items and those non-recourse items are all being allocated to members in proportion to their ownership, all this is nonsense. That's all you really need to know about this. And if you really want to talk about qualified non-recourse, minimum gain chargeback, and qualified income offset, John Campy's scratched this pretty hard. He would be the guy I would talk to. But all this is kind of noise.
So when we have 704C stuff that doesn't go 50-50, do all these get turned on?
Nope, because that's its own separate regime. Because that's a great question from the standpoint that, so the 50-50, I'm talking solely through the lens of agreed upon allocation.
Not required.
Not required. That's a great hair to split from the standpoint that you said, well, wait a minute, we spent a lot of time on 704C to say that 704C could specially allocate an item of income or a depreciation deduction based on what category of asset we have, right? And I just was up here and I said, anytime you're outside the 50-50 or the split, then you need to ask the question. But as long as you're compliant, you don't have to ask the question, right? And you're smart to say, well, wait a minute, you talked about special allocations all day. No, this is through the lens of agreed upon allocation.
Okay.
Okay. Then H, we have curative allocations. What do you think this is talking about? You think it might be traditional with curative and remedial? Generally, when they're talking about curative allocations, that's what they're talking about. Okay, and then somewhere in here, there was something about 754, and then there's distributions. So where's the waterfall in here?
Distributions.
So there should be a pointer to distributions to say that's how income should be allocated. Do you know what that pointer is? Because it pointed to 27, and that's what I expected it to be was distributions.
Well, this is preferred return than a waterfall for the manager. Basically a carried interest.
Okay, so let's do this a little bit differently. So what we know so far is, why are capitalized items important, Sam?
So can you look up the definitions?
The definitions. They're telling you what the rules are by virtue of their capitalized. Portions of the agreement I'm interested in is income loss, operating distribution, liquidating distribution, tax distribution, 754 and 704C, or 704 allocations. Okay, those are the pieces that I put in there. So when we talk about a waterfall, what you're going to generally see and what people have trended to, and what Aaron just said in this, and I don't see it visibly just yet, because I can't, I haven't made the connection yet in this agreement yet, is that income is going to be allocated in a manner to make your liquidating distribution true. Is that what you said, Aaron? Okay. So in the income provision piece of this, all right, we'll come back. I'm going to ditch this. The income provision can come in a couple different flavors. It can come in pro rata or waterfall. Okay. And on a pro rata, it's probably going to be right in the income provision to say we're splitting things 50-50 or in proportion to ownership, because it's just that simple. A waterfall is going to say something to the effect of income and loss are allocated in a manner to make the liquidating distributions true. I mean, that's literally what almost
all of them reference the distributions, the distribution section and the income allocations.
okay. So, and what Aaron said, and again, I haven't found this hook. What I expected when I saw the targeted account, when it said, look at 27. Remember how it said targeted account? It said, look at 27. And what I expected to find, and I didn't find, was 27 would say, here's the liquidating provisions if we sell. So sometimes it takes a long way around the barn, but that's what I would have expected. So the income loss is going to be allocated in a manner to make the liquidating distributions true. So let's say our liquidating provisions in this hypothetical are 1, preferred return, 2, preferred capital, 3, 80% to preferred member up to $1 million. Who cares? 4, 20% and 20%, excuse me, to common, and then 20% to preferred after the million, and 80% to common. Okay, so let's pretend that when you see this, now these are going to be capitalized in the document. When you read through the liquidating provision, these items are now capitalized. And then you're going to go to the definitions. The definition is going to say preferred return is 10%. And preferred return is 10%, generally cumulative non-compounding is generally the words that you're going to see in that. And when you see the words 10% cumulative non-compounding, what that means is you're just going to take 10% of the preferred capital every year. So if I have $1 million of preferred capital, which is, by the way, number 2, I have $1 million of preferred capital, 10% preferred non-compounding. 10% of $1 million is how much, math girl?
100,000.
100,000. So $100,000 every year has to be an income allocation to my preferred member. Whether, I mean, if I don't have $100,000 to allocate to that preferred member, then it just accumulates. But it's not like a bank account where you have compounding interest. You just have $100,000 that's going to clip as a coupon every year, regardless of what income has been allocated to that preferred member. Then, so right now we have this preferred, 10%. We have this million. Then it's going to be 80-20 for the amount for $1 million, for $1 million over these two. So we have another million that needs to be accounted for here. And then it's 80-20 split, 20% going to preferred and 80% going to common. So if we do some math and we say we've operated as a partnership for 5 years and we've made no money whatsoever, how much preferred return is due to the preferred member, Stuthman?
It'd be 500,000.
500,000. Why do you say 500,000?
100,000 each year.
100,000 each year, and we haven't been able to allocate anything to them, correct?
Correct.
All right. Okay. So we sell the assets for 3.5 million. So now what's the rules of the agreement? Because our rules are we're going to allocate income or loss based on the operating or the liquidating provision, right? So now the liquidating provision says how much goes to the first tranche.
Yeah, that'd be the 500,000.
500,000. So we have, I'm going to call it number 1. Okay. 500K. Okay. So then the next piece is how much?
The million preferred
A
capital.
million. So number 2, we have to liquidate $1 million out to the preferred. Then what?
80%. I can't read the rest.
It's going to be another $1 million. That's going to go 80% to preferred and 20% to common.
Okay.
Okay. So now we got 2. We got number 3, $1 million. Correct?
Yep.
And we have number 4, which is the excess. Okay? And how much my excess equals, it happens to be $1 million, correct?
Yep.
So now we've quantified it in total, and now we have our preferred member and we have our common member. Our preferred member, how much do they get of the 500?
All of it.
All of it. How much common get?
0.
0. Of the million, how much does the preferred member get?
All of it.
How much common get?
0.
Okay. Of tranche 3, what's my rules?
80-20.
80-20. So who gets 80%?
80%. I can't really read that writing.
Preferred.
Preferred.
Okay. So 800K goes to preferred, 200 goes to common. The excess, 20% goes to preferred, and 80% goes to common. So, of our income allocation, the common got $1 million, and the preferred got 2.5 million. Okay, so when you read these agreements, and it wasn't 100% clear, and I was hoping to see that hook come in there, and it wasn't 100% clear how that hook told you that the starting point for the waterfall is income and loss is going to be allocated in a manner that makes the liquidating provision come true. Then you have to develop an understanding of what this liquidating provision says. So the liquidating provision says 10% non-compounding cumulative amount. We went for a period of how many years, Brad? 5. How much was generated each year? 100,000. So 500,000 is the first piece of that liquidating provision that has to be allocated because we got to allocate income to make our liquidating provision true. The next piece goes to our preferred return. Goes 100% preferred. The next million is 80-20 with preferred winning 80%. The next, anything in excess of that, and I probably should have made this 4.5 million just to make the last tranche $2 million. The excess, which happened to be $1 million, got split 80-20, with preferred being the loser for getting the lesser amount, and the common getting the greater amount. So what you need to take away from this is definitions. If in a partnership agreement, definitions are always capitalized and they tell you what this is. And in general, you're going to have to go through multiple pages because it's going to point you to multiple different directions to finally figure out what it is it's telling you. Because in that one agreement with the income provision, it said, we're going to allocate income, but you got 14 point A through I or something, correct? Or A through H, or B through H. And then 14I, which affects this, which was part of my boilerplate. And the boilerplate is, as long as we're allocating income in proportion to what the ownership is, who cares? Then it should say, what Hoffman says it says, and I believe you, is that it says somewhere in there, income and loss can be allocated based on liquidating provisions. Then you have to figure out what the liquidating provision is to figure out how income is going to be allocated. Okay, so a very useful a very useful thing that we can do for attorneys, and I think we've done this, haven't we, Hoffman?
Yep. Plenty of
Is-
times.
Do what?
Lots of times.
Is we get this agreement and
Check your email right now for me.
okay.
Because what I've learned from Pete by looking at these over time is that you get these from the client and then map it out how you would expect this to go.
What's going on here?
You searched Haley. You can just click on inbox on the left.
Okay. This fella?
Yep. And that might not match exactly what we have here, but pretty close.
Okay.
So we create a capital account example with some fake numbers, like if this happens, this is how we would have this flow through. Okay, first year lost money and made money, then we roll down and
Figure it out.
yeah. I was gonna scroll down on this. There we go. So you try to map out, because a lot of times when you have these liquidating events or these waterfalls into it, you want to make the client make sure that they feel comfortable with what they have too, and it's doing exactly what they thought it is. Because sometimes you'll draw these out and show them what happened, and they'll go, "Well, that's not what we wanted." And if you do it early on, and when the partnership just starts, you're able to help them update and amend their operating agreement, or before anybody signs it all, get it set up to where everybody agrees and before they sign off. Because what will happen is, the operating agreement is the law of the partnership. Whatever it says in there is how you're supposed to allocate this. So, year one, we have some losses, some deductions. Your 2 losses, your 3 losses. Now we come down into here, and then they start mapping out. Okay, here's our income. So we have to restore back to some of our old stuff pursuant to, just map it out how it matches to your operating agreement. And then we have
So hold on. So
your
your comment of restore preferred capital to the extent depleted. So that line, I think what you're saying, Aaron, is you created a hypothetical fact pattern and you generated 1,219,000 of losses, which, going back over here, depleted your preferred capital.
Yep.
Okay. So when it depleted his preferred capital, my number's 1 million, I'm gonna make his 10. There was losses allocated to those folks which hurt their capital and took it down. So the next income that comes back in has to restore their capital back to where it originally was. So the 1,000,003 of losses that was allocated to the preferred capital line, he has to now take a step forward with income.
Yeah, typically, this started with some gain in there at the beginning, and that threw this off. Typically, you have losses, And these would be positive, so you're restoring this income back. This one got screwed up at on this front part, because with this income here. So I don't know where all that came from. That wasn't originally there. So here, where you'd see if we have income. Well, the first piece of the income we have to.
That was a negative number.
Yeah,
that was lost on me. Okay.
Yeah.
Yep.
I'm like, why is this? So first, see, look at partner 5. They don't participate in losses and they don't have a capital account. They don't have any basis, so we haven't allocated them any of the losses. So we've allocated the losses to the other 4 partners in this scenario. Well, to the extent we've allocated them losses for the past years, we have to give them back income to get them back to where they were. Now everybody's back to square one. Everybody's got their original capital accounts and that they contributed, and the other guy's still at 0. Then, to the extent we have more income, we have to go look at our preferred returns. So, like in this scenario, we have a preferred return. We have a one-time, based on how this is written, there's a first one-time preferred return, and then you reference where this comes from in the operating account. So we're allocating all this income here, preferred returns. And then whatever's left over, 15A, which was the pro rata income.
Okay, so what I think you're saying is you're taking an operating agreement before $1 is made, running through fictional income, fictional losses, and showing what your interpretation of how those dollars would interact with an allocation based on your interpretation of the agreement. Then you're sliding that across the table to the attorneys and the client saying, this is what I think happens. And the attorney can say, yep, that's congruent with the words. That is what happens. And the client can look at it and say, that's not what I wanted to have happen. Well, what did you want to have happen? Then you can tweak the crafting of the document to comply with what the attorney and the client want. And then, would you ever attach this as an exhibit?
Yeah. We
Okay.
have in scenarios, especially the more complicated it gets.
Okay, so when we're negotiating to get a partnership off the ground, are we friends or are we enemies?
Everybody's friends at the beginning.
Everybody's friends at the beginning. But if we somehow get sideways with each other, are we friends?
Not so much.
Okay, so the fact that you go through this at the very beginning and we're agreeing to the rules of engagement based on the words in the document, and we're putting a mathematical analysis that attaches to those words, and everybody goes, yep, that's what we meant. And you have income items, profoundly disproportionate items of income and loss going through there that turn on these provisions, that turns on these provisions to say this is what happens, and then this what happens numerically, and we tie that in to the numerics of the words. It's kind of a little harder for somebody to say, well, that's not what I meant.
Right. We've had a scenario where we didn't help with one at the beginning. We had a deferred development fee that waterfalled in, and the second everybody gets their original contributions back. Then there's restricted units that they received. We talked about those yesterday, and they get allocated a portion of income, and so their capital account would have been allocated income on a liquidating event. Well, it wasn't written into the agreement that way in the ordering, so everybody just assumed that was going to happen. If you played it out by the operating agreement, we would have people at the end with getting more cash because we didn't allocate the developer fee. So they're like, hey, we just got allocated proportionate. Like, no, we should have got that, our cash back from that. And I go, well, it's not written in there. Luckily, everybody was friends still, and they did well on the property that they sold, so they did it the way they originally intended. But if we had a scenario where they didn't agree and sold it, they could come, one of the partners could come back and say, nope, I should be allocated my proportionate with disregard to the developer fee. And I would have got more income and more cash.
Did you do an amendment to the partnership agreement?
No, we didn't. Because it was, they had already closed everything out. And allocated the cash the way that they intended.
If
Most of
you,
them were, they was all family members.
if you have the ability, Aaron, to rip apart a partnership agreement and put it back together and convey this back to attorneys with numbers, do you think that's more valuable or less valuable than other things?
I think it's pretty valuable because it's the start of your partnership. And
I mean, just from us adding value, though.
yeah, oh yeah, 100%.
So I mean, this if you can do this, if you can take a partnership agreement and go into these pieces and make sure that they're working congruent with each other, and you can have a conversation, and then you can translate your interpretation of what these provisions are into a model and push it across the table. That's pretty valuable. That's putting everybody on the same page. And that's why I say I start with capitalized items, income, operating, liquidating, tax distribution, 754 and 704C, or 704 provisions. Because those are the ones that affect our world. Lots of other stuff there is just lawyer noise, from my perspective. That doesn't make it not valuable, it's just not valuable to me.